In this video, we will explore about other critical aspects to study from financial reports. Beyond the standard profit and loss numbers, we need to look at three specific areas that impact you as a shareholder. These are the history of equity expansion, the history of dividends, and the buying or selling activity of insiders. Let us start with the history of equity expansion. When a company needs funds, it has two main options. It can take on debt or it can issue equity. Debt is easy to understand because the cash flows are contractual. You borrow money, you pay interest, and you return the principal. However, equity issuance is much harder to analyze because it changes the ownership structure. When a company issues new shares, the cost of these funds falls on the business and eventually on you, the existing investor. So, watching how a company raises money is critical. There are four specific models a company uses to issue shares. First is a rights issue, where shares are offered to existing shareholders based on how many shares they already hold. Second is a public issue, which happens through an initial public offering or a further public offering to the general market. Third is private placement, where shares are sold to specific big investors through preferential issues or qualified institutional placements. And fourth is exercise based issuance, which happens when employees or warrant holders convert their options into actual shares. This brings us to the concept of dilution. Think of the company as a pizza. If the company issues more shares to new people, your slice of the pizza gets smaller. This is called dilution. If a company finances its growth using its own profits, known as internal accruals, it is the best case scenario because your stake remains safe. However, if they constantly issue fresh shares to outsiders, your ownership percentage drops. As an investor, you must check if this fresh issuance is actually creating value that justifies your smaller slice. Let us take a deep dive into preferential, allotment, and QIPs. When a company allots shares to a select group of investors, there are two ways to look at it. The risk view says this dilutes minority shareholders, but the opportunity view suggests that these big investors might be bailing out the company during a crisis, which keeps it alive. You should always check the valuation. If these shares are sold at a premium price, it is good for you because it adds value. Also, if big institutions are buying through a QIP, it shows they have confidence in the company's fundamentals. Now let us move to dividend and earnings history. To understand dividends, you must look at the life cycle of the business. In the growth phase, companies rarely pay dividends. They keep the cash to fuel expansion because they can generate returns higher than what you could get elsewhere. However, as the business enters the maturity phase, growth slows down. At this point, they should start paying out high dividends because they no longer need all that cash for reinvestment. The industry type also dictates dividend behavior. We have defensive industries like those selling toothpaste or biscuits. Examples include Colgate, Palmolive, or Britannia. Since their business is very predictable, they offer regular dividends, often even interim ones. On the other hand, we have companies that use active management. They try to create stability by saving money in reserves during good years so they can still pay you dividends during bad years. You can verify this by reading their formal dividend policy. Another way companies return money is through share buybacks. This is when a company buys its own shares from the market and extinguishes them. Companies often prefer this over dividends if it offers a better tax advantage for them or the investors. For you as a shareholder, this offers a choice. You can either sell your shares and take the cash, or you can hold on to them. If you hold, your percentage ownership in the company actually increases because the total number of shares has gone down. Dividends and buybacks are also powerful signals about the future. Imagine a company usually pays dividends but suddenly stops and retains all the cash. This could mean they are planning a major investment, which is good, but it could also mean they expect a challenging future and are hoarding cash for survival. Conversely, if a high growth company suddenly starts paying huge dividends, it might mean they see reduced growth opportunities ahead. The golden rule is simple. If the dividend policy changes drastically, you must investigate why. We also need to look at the history of corporate actions. These include things like bonus issues, stock splits, and rights issues. A bonus issue adds free shares to your account, while a stock split divides one share into many. While these do not directly change the value of your investment immediately, they directly affect the share price and liquidity in the market. We will cover the detailed mechanics of these mathematical adjustments in a separate dedicated video. Finally, we look at ownership and insiders, sales and purchase of stocks. This relies on the concept of information asymmetry. The owners and promoters are closest to the business. They know things you do not. If they are buying or selling shares in their own company, it is a huge hint. Of course, they must follow strict SEBI guidelines when they trade. As an analyst, tracking these moves gives you a critical peek into the company's true health. To summarize this, we can look at a quote from the legendary investor Peter Lynch. He said that insiders might sell their shares for many reasons. Maybe they need cash to buy a house, or they want to diversify their portfolio. So selling is not always a bad sign. However, if insiders are buying, there is likely only one reason. They believe the company is going to make huge profits in the future. Therefore, insider buying is often the strongest signal you can find.